Hello, my friends. Today is July 22nd. My name is Joseph, and this is Markets Weekly. This week, we're going to talk about three things. First, we're going to go over what we learned from the bank earnings reports this past week. Banks, of course, have a lot of information as to what's happening in the economy, so it's definitely worth a listen. Secondly, we're going to talk about the prospect of inflation reaccelerating later on in the year due to ongoing wage increases. And lastly, let's talk a little bit about this interesting research done on the crypto wealth effect, where researchers look at the explosion in crypto wealth and find how it's influencing the real economy. Okay, starting with bank earnings. This past week, we had all the mega banks announce their earnings, as well as many regional banks. Now, banks have a lot of inside information as to what's going on in the economy. If you're a JPM or Bank of America, for example, you have millions of people who have accounts with you and millions of people who have credit cards with you. So every day you're looking at that data and you're getting a really good sense as to the health of the US consumer and the broader US economy. Now, overall, and this is pretty consensus among all the big banks, is that the US consumer is doing fine. So the growth in spending year over year is moderating, but it seems to be normalizing to the pace that we saw pre-pandemic. So over the past few years, obviously, people were flush with cash. They were buying a lot of stuff. Today, they're still spending, but they're spending at a moderating pace. So it's normalizing. And part of that is because of the overall level of inflation has declined. For example, let's look at gasoline. Gasoline prices today are a lot lower than they are last year. So if you're looking at the amount of money consumers spend on gasoline, well, that's going to be a lot less this year than last year. If we were in a recession, what you would really expect is for consumer spending to be declining as a negative. But it's not declining, it's just growing at a slower pace, a more normalized pace. Now, across the bank earnings, here are some of the things that I thought were most notable. Well, first off is that banks widely report that their loan growth is basically static or maybe marginally increasing by, let's say, 1 or 2% annual rate. And this is what you would expect as interest rates go higher, and indeed, it's the intention of the Fed. So when the Fed raises interest rates, it's trying to stop or slow down bank credit creation. Because when you have more bank loans, what that means is that people have more money to spend. And if people have more money to spend, that's more demand in the economy. And that makes the Fed's fight against inflation pretty difficult. When interest rates go higher, two things happen. One, the supply of bank loans declines. This is because banks, seeing that the interest rates are going higher, the economy is slowing, they are more wary of their borrowers having trouble repaying them. So they are less willing to lend because of higher credit risk. The second thing that happens is, of course, borrowers looking at higher interest rates, they're less interested in borrowing. Say someone who wanted to buy a home, but now looking at mortgage rates being 7%, a little bit less willing to buy. So both the supply of credit, bank credit contracts, and the demand for bank credit contracts. So the overall growth in lending by banks slows down. And we see that happening right now. And it's been happening for the past actually 6 months since the late last year. So that channel of monetary policy is working to slow the economy. The second thing that I thought was noteworthy was that banks widely report that credit quality is good. So when banks make a loan, they want to make sure that the loan is paid back. If there is some stress in their credit portfolio, what they would see is they would have higher charge-offs and they would have higher allowances for losses. Now, both those numbers are inching up higher for a wide range of reporting banks, but they're also rising from very low levels. So again, what we're seeing is a normalization of credit quality to levels that were prevailing before 2020. So overall, credit quality remains quite strong. It's normalizing off very, very, very benign levels to levels that were prevailing before 2020, when actually credit conditions were still very good. Now, let's zoom out a little bit and think about what we've been seeing over the past several months. So in March, there was a big panic in the banking sector, and a lot of people were worried that we would have banking crises that would have a significant impact on the economy. And if you were following me back then, I told you then that really is not in the cards. It's hard to see. And this latest crop of bank earnings 2 quarters afterwards continues to affirm that view. And of course, the Fed has also been looking at their data and saying the same thing. What happened in March does not seem to have had a big impact on the behavior of banks. We see tightening credit conditions, but that's what we would expect in a rate hiking cycle anyway. One thing to note is that there seems to be a different impact on high interest rates for the big banks and the smaller banks, where the smaller banks are having their profitability impacted a bit more due to rising deposit rates. And I write about that in my weekly piece on Monday. Now, let's talk about the second thing, and that is the prospect of inflation reaccelerating later on in the year. So the framework that I use when I look at inflation is, inflation is prices rising, right? Let's say prices rising 5, 6, 7%. Now, usually you would expect that if prices rise 5, 6%, well, people will not want to buy it anymore, right? Higher prices, less demand, and so prices would have to come down. So inflation can persist at relatively high levels when people can continue to afford higher price increases. Now, people can afford higher price increases if, for example, they're able to borrow money. Let's say mortgage rates are really low, but that's really not the case anymore. They can also continue to afford higher prices if they continue to have higher wealth. So let's say the stock market continues to rise, they can sell their Nvidia stock and use that to finance higher consumption, and that seems to be still the case. The last way, and the more common way that people can afford higher prices, is if their wages continue to increase. So let's say prices increase 5% overall year over year, but your wages are increasing also 5% overall year over year. So you can still afford these higher prices. So that's part of the reason why that the Fed is really intent on getting softness in the labor market as a strategy to get inflation under control. From their perspective, as long as wages continue to increase, say 5%, 6% year over year, then it's really hard for inflation to go back down to 2%. Now, they're struggling, though, against titanic macroeconomic forces that we're beginning to see surface today. So what do I mean by titanic macroeconomic forces? These are the forces of demographics. So zoom out, people had larger families for all of history. Starting in the 80s, they had smaller families, and we're seeing the results today. The prime working age population of the United States basically has been static since 2016. So if your workforce isn't growing as much as it used to, then obviously you're going to have less supply of labor, and that's going to lead to some structural labor scarcities, especially as the boomers are retiring. So we've been seeing that play out over the past few years, and we're continuing to see it play out now. So if you look in the news, there's been a lot of activity for strikes. So you have UPS, who employs about 300,000 people on strike. You have a whole bunch of actors and writers in Hollywood on strike. Most recently, we had labor disputes with airlines that ended with, let's say in the case of United, airline pilots getting raises of 30 to 40% over 4 years. So we're seeing, because of these structural demographic factors, a big shift in bargaining power towards labor. And this is actually, I think, a good thing, because if you zoom out a little bit more, you see over the past few decades, even as we've become wealthier and wealthier as a country, the gains haven't been evenly distributed. Labor's share of national income has gradually declined, in large part due to globalization. So the entry of China into the global workforce through the World Trade Organization basically increased the supply of labor by a few 100 million laborers. So obviously, if you increase the amount of workers in the economy to that extent, labor prices are going to decline, and thus the wages and labor's share of national income. But we're seeing that revert through demographics. And if that continues to play out, then that's a very different world. One, of course, is that wages will continue to grow since we're running out of people. And that makes inflation, I think, difficult to solve, since workers like to consume a larger share of their wages. If you give a rich person a lot of money, they're going to go and buy assets. So you get asset inflation, which is what we've been getting the past few decades. But if you give a lot of money to someone who is not as wealthy, maybe middle class, maybe blue collar people, then they're going to spend more of it. And that manifests in higher demand for goods and services, and that's more inflationary. An interesting corollary to this is, of course, the problems of the past may not be the same problems we have in the economy in the future. So in the past, the common problem was high unemployment. We would have economic downturns where a lot of people would be out of work. Now, if we're heading into a world where labor is structurally scarce, then unemployment is not going to be as big a problem as it was in the past. We're going to have a persistent tailwind where people who want work will be able to find it. So I think that's a good thing. I think we're just in the early innings of this big process. Now, this labor problem is international. So we see the same problem happening in the UK, for example, as well. And of course, in continental Europe. So labor costs are probably going to stay high for the foreseeable future. And that's going to change a lot of things. Now, the last thing that I want to talk about is the crypto wealth boom. So as we all know, crypto prices have risen significantly over the past few years. Now they're down. The price of Bitcoin, for example, is down from its highs seen a couple years ago, but it's still significantly at $30,000, significantly higher than it was pre-pandemic. The interesting thing about this is that Bitcoin and all these other cryptocurrencies, they are decentralized. So there's not actually a lot of good data on this. When the Fed is compiling reports on household wealth, for example, it doesn't include any of that crypto wealth. And overall, the crypto market cap is in excess of $1 trillion. It's not all in the United States, but $1 trillion is a big chunk of money. And that's all absent from official data. And of course, if you suddenly have people becoming really wealthy off of crypto, that's going to have real economic impacts as well, otherwise known as the wealth effect. People have more money, more wealth, they go and monetize it and spend it on goods and services or other assets. It's kind of like winning the lottery. Now, we haven't had good data on this crypto impact on the real economy until now. So a team of researchers basically got access to a confidential data set that has the bank account data of about 60 million people in the US. And they were able to track these transactions from these bank accounts, trying to pinpoint just how often do people participate in crypto based upon their transactions, sending money to, let's say, Coinbase or other crypto exchanges, Coinbase by far the largest, and seeing withdrawals from Coinbase to kind of have a sense as to who's participating in the crypto market and what do they do with their crypto gains. And what they found was pretty interesting. Overall, people who dabble in crypto, they tend to be higher income people, and they tend to think of crypto as just as part of a broader portfolio of assets. So when they have huge crypto gains, they usually sell out of some of that crypto and rebalance into other assets, say stocks or real estate. One finding, so bear in mind, this is a finding, economic findings, so with a grain of salt, but still interesting, is that they find that the wealth effect from crypto gains actually has a higher marginal propensity to consume than equity markets. So they're estimating the marginal propensity to consume for crypto wealth to be, let's say, about 8%. So if you have 8% in crypto gains, if you have $100 in crypto gains, maybe you spend about $8 of that on consumption. So if you're thinking of someone with $1 trillion in crypto gains overall, not all of that is in the US, then that's some impact, some boost on the real economy. Another really interesting they found, for context, the estimated wealth effect by stocks is about 2 to 4%. So it's much smaller than the crypto wealth effect on consumption. The second thing they did, which was pretty interesting, is that they looked at the location. So they have some locational data based on these accounts as to where all these crypto wealth, these people who benefited from the crypto wealth boom live, and try to find a relationship between that and housing prices. And what they found was it seems like people, areas that had a lot of crypto wealth seem to also experience higher house price appreciation. So you can think of it as someone who basically won the jackpot in crypto, selling out some of that money and taking it to buy a house. Now, it's really hard to know just how big the macroeconomic impact of this is, but it makes sense, right? It's like someone winning the lottery. They suddenly have a lot of money, and they're smart enough to know that this stuff goes up a lot, it could go down a lot. So maybe I should diversify a little bit out of this and buy real estate instead. So that seems to be the case. So this is actually, I think, part of a broader discussion on the impact of wealth on the real economy. So there's this wealth effect from crypto, but broadly speaking, obviously, the even bigger asset class is stocks, and there's many more people participating in the stock market. And what we've seen over the past few months is a tremendous rally in stocks, particularly tech stocks. So a lot of people have a lot more money to spend, and that again is going to keep, I think, consumption, inflation, and asset price inflation, let's say the spillover between the stock market and real estate market, to be supported. So from my perspective, as long as I see wage gains pretty strong and wealth remaining pretty supported, it's hard for me to see inflation coming down. You see all these people continuing to have significant asset price appreciation. They can sell that, buy a house, or buy more goods and services, buy fancy cars and so forth. So I think for inflation to come down, the Fed really needs to engineer a significant haircut in asset prices, which we may eventually see. Things are taking a stumble now, but it's always hard to know. All right, so that's all I've prepared for today. If you're liking what you see, please remember to like and subscribe. If you're interested in hearing more about my market commentary and having a better understanding of the financial system, check out my blog at fedguy.com. I publish weekly analysis on the markets. And if you're interested in learning more about understanding markets in general, I recommend my course, Markets 101. You can find it at centralbanking101.com. It is basically the same course that I would teach the junior traders on the Fed's trading desk. All right, that's all for today. Thanks so much.